Good morning, traders. It's Friday, February 28th. Taking a look at the charts, we're going to start off just with the FinViz, looking at their kind of big board here of all their different asset classes. And if you take a look, we've seen the big sell-off in the stock market. Stocks are down another 0.75% again this morning. The VIX continues to rip to the upside, and we might get today is Friday, the last day of the session. This was an important week last week, and we wanted to see how the market was going to react because last week we saw precious metals start to break out, and equities were showing signs that it was rolling over, and the market, the metals did pop, have a move on Monday, and then they got rejected and sold off, and now we're seeing everything sell off. So if we just look in general of the last few bars here on all these charts, obviously we've seen huge selling. Now if we take a look over at the energy sector, same thing, everything has been selling off. If we take a look over at the metals, big sell off in silver, platinum. They've all been moving down all week. And even if we take a look at currencies, the dollar was down, and we're seeing a lot of these other currencies start to rally. The euro, the yen. We're starting to see some trend changes here, and it's interesting to see how it's going to recover. Obviously, the dollar is down towards a support zone from a previous level over here. It's looking a little long in the teeth to the downside. The other currencies that have rallied, like the euro, obviously it's bounced up to a resistance area. So these moves could be somewhat almost over in terms of the currencies, but again, we're seeing a lot of big moves in the market, and things seem to be changing. Now, let's take a look. The only thing that's actually up this morning are bonds, and let me just pull it up here. Here's the chart of bonds. Bonds have been kind of the real safe haven. We got a piece of the gold miners. We got out at the opportune time with half of our position. We held bonds, and bonds continue to move up. Bonds will be up over 10% at the open this morning for us from our entry position. So overall, bonds really continue to be the safe haven play. The short term, you can see the short term really popping to the upside and taking off overall. Now let's just look over the charts here. Here's the equities market. You can see stock market sold down quite a bit this morning. It was down, I think, 1.5% or more than that actually. I think it was down about 2% at one point. Came all the way down to this previous low. Let's just zoom out on the chart. This is a really significant area, and you notice this low is right through the heart of all this oscillation. It's through the middle of it, so this is a pretty critical support zone on the chart. Obviously the stock market is oversold, but again, we're in this huge wave of selling, news driven, and you can see this type of volume. We're very close to, I think, a knee-jerk reaction, very similar to what we saw in 2008. Let's go to 2018. If you look at this big extended run up and then this big drop, if we go back to 2018, and we look at the same type of thing, we got the same type of price action, market just minor moves, just the slowest grind higher and higher over time. And then you get into this parabolic, well, not so much parabolic, but a very strong grind where everybody just piles into the market, and then it just completely collapses back down to where it just broke out and originally started the trend. And I feel as though we're going to be into this type of price action. Huge lower wick, big strong close, and then a big double dip type of thing. I think we're going to get into some really big, wild price action here, and we should see bonds during this time continue to move higher. Now, when the stock market has a really strong bounce like this, I wouldn't be surprised if we see bonds, safe havens, actually pull back even more. So I think we're getting close to a point here where bonds are on the verge of starting to pull back, and stocks are going to have a very strong rally. And after that, I think this whole sideways range in this market is when bonds can continue, and safe havens, gold and silver, can continue to move higher during this time of uncertainty. And that's what we've seen. That's what you see in bull markets. When the stock market, after it has a huge drop and it trades sideways in a range for a long time, these are big percentage moves on this particular chart. But as it trades sideways in this range and really goes nowhere, the chart of bonds, and we should see metals and things like that continue to work higher and higher and higher. So it's not so much shorting the market. If it starts to break down, that would be more or less a shorting opportunity to the downside. But in a bull market, usually the big bouts of selling hit and then it trades sideways. And during the sideways time is when more or less we should be into the safe havens because they just keep grinding higher as everyone is fearful constantly through this phase. And eventually when it breaks out of this phase, somewhere over here, that's when we actually get long into the equities market again. It could continue to go higher, and we would be exiting bonds or safe haven plays, and they would start to go lower and correct. So that's where we are in terms of the market cycle at this point. In terms of this past consolidation, and even this one, I've talked about this a few times before, but more or less when the market has these bouts of selling, it only takes 2 or 4 days or so for the market to drop. The trend doesn't really usually change to somewhere in here or right here. Trying to short the market for a half of a day type of move and then it knee-jerk reactions and just trade sideways is not the best way to trade the market. You can't really short the market unless you're trying to pick a top, which we don't try to do. And once we're in a bear market, we will be focusing on shorting equities with an inverse ETF. But because in a bear market, we'll continuously have these long legs to the downside with small consolidations where we would be getting new setups. But overall, when the equities here are trading sideways and all of these situations, this is when we were into safe havens or bonds and we see bonds take off. And then as soon as they start to break out of this is when we start to see the bonds correct and go flat for a while and move down. And eventually they start to rally again during these sideways times. And then when the equities market breaks out, it'll consolidate. And we've been seeing them kind of creep sideways. We saw the same over here. We saw a nice pop in bonds, and now it pulled back a bit. But and then of course we're still long bonds actually from this position because bonds and equities both still had a buy signal, and bonds are way up here in this upper channel, up about 10% for us now. Well, stock market is down 13%. So that's kind of how it plays. And as this starts to move forward, going forward here, if we start to get continuation in some big range here, we're going to continue to as the stock market bounces to the upside, we're going to see our bonds play probably pull back a little bit, consolidate, but as this oscillates and change trades all random through here, bonds should hold their ground or continue to move much higher going forward. So we're in this phase here where we could have months of big sideways rotation, and it could be the flock to safe haven plays. And the big question will be is, do we hold this level going forward in time? And if we start to break down here, it could be the start of a new bear market. A lot's going to play on what happens with gold miners and metals. Do we see bonds and metals and miners pick back up and really start to take off and lead the way, which we talked about last week? Stock markets had a nice run, but bonds, utilities, and precious metals like the miners are outperforming the stock market in a huge way. And that's what happens the last few months into a bull market before it rolls over and breaks down and we get into a technical bear market. So lots of interesting price action going on. Now let's take a look over at metals this morning. Gold down 0.75%, continues to pull back. Looking at silver down 2.3%, really flushing down even more. And the gold miners, you can't see it on this chart. I might be able to see it if I type in 1440 minutes, which is about a day. You can see gold miners this morning. This is the red bar for this morning in pre-market. We are down another 3.5% with gold miners. And this is why we don't fall in love with positions. This is why we get in. We locked in our 10, almost 10%. We had our stop move to break even. We got out over here, and then it's completely collapsed. So, by the end of today, miners could be down 20% in only a few sessions, and it went from plus 10 to minus 20. So it's pretty significant. And traders who are holding a play that was up 10 and now down 20, that just hold through a 30% swing, obviously have some serious issues of falling in love with plays, not following trade management. That is a huge swing. I would take 10% any day of the week on any play, but to hold it for a 20% loss, is pretty deadly for a position like this. So overall, we got to make sure we get out and use these exit plays when our stops get hit. You've got to get out because they're at certain places and levels that if they're broken, the market is going to completely collapse, and that's why we have our first target levels at up here. Once our first target level is hit, that is a critical level. If it's rejected, the price is going to collapse and pull back. So you've got to take money off at the first target and then move our stop to break even. It's important. If we can break through the first target level, then we should be flying up to the next level, which was going to be the $50 mark, and it still could hit that down the road. But overall, we're not the buy and hold type of group. We're getting in, getting the money, and then moving out and reloading for a new trade after that. Looking over at natural gas. Natural gas closed below our stop yesterday. This morning it is trading lower. And at the open bell, if you didn't get out at the close yesterday, at the opening bell, we get out of natural gas. Natural gas, we've got a small position in. It's about 12.5% of our account. Knowing it's really volatile, we can take a much larger haircut percentage-wise on that trade, and it ends up being a very small amount of our overall portfolio. And that's why position sizing is critical. If you're getting into something that's really volatile, has more risk, you just downsize your position so that you can take a 10, 15 or so haircut on natural gas, because it moves 10, 15% very quickly, very easily, but that really only turns into about 1.5% or so against your entire portfolio if you were to take a full, 12, 15% loss on a trade. So position sizing allows us to play volatile asset classes and to potentially take a 10 or 15% haircut on it, but knowing that it's a small position, even a full 15% haircut, it's only about 1.5% or 1.75% on the entire portfolio. So it's all about keeping risk minimized with position sizing, and the higher the volatility, the smaller the position, and it's all about chipping our way up and building our accounts step by step. So we'll be getting out of natural gas unless it recovers here in the close. By the opening bell, it needs to get above our stop price. If not, we're out at 9:30, and we move on for looking for some new plays in the market. Looking over at crude, down 3% this morning. It was down about 4 and change. Overall, it came all the way down to 49. I think the low today was 44.99. So it came down to that 44 zone. We can see it broke below this low and then continued to go down. And so it came down and tagged that 44 area. And now we're going to start to see if it gets some traction here. Overall, this is a really significant resistance zone, or sorry, support zone on the chart. Just looking at this level right here, this is a really important low. This here is the low area where a lot of bars came down and tagged 44. In between this area is critical support zone. So overall, it's coming down to that level today, and we might see that 44 tagged. But overall, that drop to this area has more or less now been tagged because it got to 44.99. Anywhere in this 42 to 45 area is this kind of pocket of support. We've got big selling volume. We'll see what goes on over the next few sessions, but overall continues to be under pressure and move lower there. Last but not least, this is the weekly chart of the VIX. You can see here in the VIX in pre-market, it was trading all the way up here to $47. More or less, this is a really significant point in the chart. This is what we talked about yesterday in pre-market, that when you get up to this level here, anywhere into this kind of spike zone or above, that is a really significant level where fear hit a key point, and then we've seen the VIX fizzle back out. Sometimes it's lingered up here for several weeks. Remember, this is a weekly bar, so it could linger up here for, it looks about 2 or 3 months, potentially up in this area. Most times it just tags this intra-week and then falls back down, but overall the VIX came all the way up and got to this area once again. So this is a really critical point on the charts where the equities market should start to find a bottom, and usually we'll see the VIX. It doesn't mean the stock market will find a bottom. We usually see the VIX actually spike up to this level, and then it'll start to fizzle down, but the stock market can still fall even if the VIX fizzles down from this level. So we could still see, even though the VIX maybe fade back down, we can see the stock market continue to make some new lows over the next 3 or 4 days. The VIX kind of actually peaks out before the stock market when we get into this type of market condition. So overall, on a VIX standpoint, shorting the VIX for a fade back down over time is a play that could be done here. It's a higher risk play. VIX moves extremely fast. It would have to be a very small position, and you need to be able to short the VXY, the VIXY. I think it would be the VIXY or TVIX or UVXY. If you're able to get short shares, I mean, to take a small position knowing that it could fizzle out from 40 or 45, wherever it's going to be at the opening bell today, and get back all the way down to 14, 15 area is a pretty decent return. But again, you have to be on a very small position in order to do that. And I'll talk to you in a little bit. Bye-bye.